Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, last week I discussed the historic moves in investment markets in the first half of the week, and it's well worth going back to listen to that show and understand where the market has been. Now, if you had only looked at equity markets at the start of last week and at the end of last week, you would have been forgiven for wondering what all the fuss was about, because believe it or not, the S&P 500 finished last week in positive territory, and that's despite the volatility and carnage we'd seen over the previous 5 trading days. Now, while the phrase all's well that ends well springs to mind, we are not quite out of the woods just yet. Now, Monday brought to a close a dismal January for equity markets globally. Now, if we run through them, the tech-heavy NASDAQ 100 in America finished January down an eye-watering 8.52%. Now, the Japanese Nikkei 225 was down 6.22%. The S&P 500 in the US was down 5.26%. The MSCI Asia ex-Japan index was down 2.74%. The German DAX was down 2.6%. And the MSCI Emerging Markets Index fell 1.83%. And it meant that US stocks in particular endured their worst January since the financial crisis. And the real outlier was the FTSE 100, which finished January up 1.08%, boosted by its lack of tech exposure and high energy stock exposure, something that's held it back previously. But it was not all doom and gloom after I made last week's show, because equity markets then embarked on their strongest 4-day rally since November 2020. And if you recall, that was after Biden won the US election and the COVID vaccine was first announced. Now, to give you some perspective, at the start of Wednesday, so that's today, the S&P 500 was sitting just shy of 4,600, which is quite the turnaround from the low of 4,222 that we saw on Monday last week. Now, the factors behind the move higher include a number of US Federal Reserve members making statements over the weekend that were deemed more dovish than the one made by Chair Jerome Powell last Wednesday. Now, the situation in Ukraine hasn't so far escalated into an all-out conflict, but perhaps the biggest driver behind the positive sentiment has been a number of strong earnings reports from companies. Now, this triggered a short squeeze. That's where those betting that the market would fall are forced to buy stocks to unravel their bets, which pushes equity markets higher. And that's what we started to see at the end of last week into this week. But from a technical analysis point of view, the previous support lines that I've mentioned, so for example, on the S&P 500, you recall I pointed out the 4,500 level, the 200-day moving average, and 4,600. Now, they turn into lines of resistance on the way up. And what that means is that the market has to gain enough momentum to break through those barriers if it is to continue higher. So it was always unlikely that any rebound would be as aggressive as the sell-off that we saw just a week earlier. And as I make this show, the S&P 500 has begun to falter around the 4,600 level. Now, this week was always going to prove tricky for tech stocks with so many big names announcing earnings. Now, after last week's show, Apple announced strong earnings results, as did Google. Now, if you recall, the parent company is known as Alphabet. Now, the latter actually saw its share price jump 10% on Tuesday as a result of its strong earnings report. Now, this added fuel to the rebound I've already mentioned of the previous sessions, and US stock markets began approaching levels where a potential break higher towards those recent highs was on the cards. But after markets closed on Tuesday, Facebook decided to spoil the party by unveiling disappointing earning results, which included the fact that daily active users of the platform fell for the first time ever. Now, the share price of Facebook, now if you recall, the parent company is now called Meta, well, they're currently down 25% as I make this show today. So 25% in a single session, which is quite incredible. Now, similarly, disappointing reporting from PayPal saw its share price fall 25% yesterday. So these disappointments have now heaped pressure back on technology stocks as investors grapple with the tightening monetary policy in the US, as well as historically high stock valuations for the sector. So as I make this show, the NASDAQ 100 is down by over 2% today, and the S&P 500 is down over 1%, dragged lower by Facebook in particular. And don't forget that Facebook, or Meta as I should say, accounts for a 2% weighting in the S&P 500. Now, what this means is that once again, investors are grappling with volatility and the possibility that we could see another leg lower in equity markets unless dip buyers come out in force, as we saw at the start of this week. Now, with Amazon due to announce its earnings figures after today's close, they will perhaps take on even more importance and influence as to which way markets may go in the short term. But adding to the negative mood today was the historic jump in euro area inflation versus market expectations. Now, if you throw in the fact that President Lagarde, so that's the president of the European Central Bank, seems unwilling to double down on her previous view that the ECB was unlikely to hike rates in 2022, now that has soured the mood for equity investors globally. And of course, don't forget the Bank of England did in fact hike interest rates today from 0.25% to 0.5%, but this was largely expected and priced in by equity markets. But what we've seen are bond yields rally, and we've seen the 10-year US Treasury yield go back to 1.84%. So right now, bond and equity investors are struggling to find a sense of direction, and the coming days will likely be telling as to which way they will go. And there is a potential for the move to be quite aggressive, but it isn't unusual to revisit recent lows before markets establish a new uptrend. So keep an eye on that 4222 level on the S&P 500, but also keep an eye on the US dollar because it's fallen 2% from its recent high. And if it does establish a new downtrend, that could be positive for risk assets. But the real big question is the recent rebound likely to take us back to new highs? Or is it in fact a bear market rally? So that means a rally within an unfolding bear market. It's something that we're going to have to wait to see unfold. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me, Damien, at Money to the Masses is the email address. Money to the Masses is the Twitter address. We're on Instagram, Facebook, TikTok, and most of all, don't forget to subscribe to our YouTube channel.
Whoa.